you guys have seen any. Sometimes it seems to work, and I think it depends on when I start recording. If it's got the proper light coming into the camera, it doesn't adjust automatically. I need to check if that's a setting I can do. Okay, next problem. Let's see, what is the next problem? Okay, market for cantaloupes. Suppose that the market for cantaloupes is currently in a long-run competitive equilibrium at a price of $3 per melon. A listeria outbreak in cantaloupe crop leads to a sharp decline in demand for cantaloupes. In the short run, what will happen to the price of cantaloupe? Explain and use a graph to illustrate your answer. All right. Let's see. I guess let's kind of read ahead here. In the short run, how will firms respond to the price change? What will happen to producer surplus in the short run? And then finally, what will happen in the long run? So this is working through a little bit lengthier of a problem. What do you got? Okay, shift to the left of the man. Good. Sounds like a good start. So we're basically tracing through a long-run adjustment in the market from a shock to the system. And if we put our home base up that we have for perfect competition, go ahead and put some sort of supply and demand curve. Firm is a price taker. Everything's hunky-dory. It should say it. So suppose that the market for cantaloupes is currently in a long-run competitive equilibrium.
So that makes
Perfect competition, yeah. Anytime you see just competition, it may not always say perfect, but you can assume that those are the conditions. All right, so what does the rest of the graph look like in long-run equilibrium? So what's some of the predictions we have in perfect competition with long-run equilibrium? Still got the representative cantaloupe producer over here. This is, of course, the cantaloupe industry as a whole, the market. Long-run equilibrium. What's some of our, you got to have these off the top of your head, kind of like bing, 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 price taker. What else do we know about firms in the long run in perfect competition? Demand curve's flat. What else? Great. You're even fancier than what I want to hear you say. What does that imply? Just kissing it, but what does that imply? So like I said, you're getting fancy. You're describing a condition. What's true because of that, where no economic profit. So firms in the long run don't have any economic profit. Profits are a signal, and if there are economic profits, if that's the signal going out to the market, what are we going to have happen? More firms enter. So enter. That's the signal coming out with the profits. If firms are losing money in a competitive situation, what kind of signal's going out? You suck, exit, get out of here, leave. You've got higher opportunities that you could be pursuing, right? So that's important. So that gives the picture of what John had down and Chelsea had down and related to the demand equals marginal revenue. There'd be some sort of marginal cost curve, upward sloping J shape due to the law of diminishing marginal product, gives us the law of increasing cost at the margin. And then that average cost curve would be just kissing that point. We know that that has to happen because of the relationship of average and marginal. That's why it cuts through the minimum. So we didn't do the GPA example in this class, but we had my class overall GPA goes up if I get grades this semester higher. My overall GPA starts to fall if I get grades below this semester. Okay, yes, Rhiann.
Okay, the average total cost curve crosses, like the lowest point on the average total cost curve hits demand and marginal cost?
Yeah, in long run equilibrium, yes. So I'm depicting a long run equilibrium of the zero economic profits is essentially what I'm showing now. Okay, Sam?
No.
Okay. Now, that's how we start off this problem. This is just the basics of, I need to know this, have this memorized as an intermediate micro student and as an economics major. This one's got to be kind of burned into your head. Now, just for fun, we don't always draw this, and it might not be needed here, so I'm going to draw it kind of just with a dash line. But remember, the average variable cost curve is cutting through, hitting the minimum, and coming up too. So that's in the back of our minds related to the shutdown point and all of those issues that you'll work on some homework problems and need to know for Monday as well. Okay. That's our average variable cost. So this problem, though, we're not really talking about variable cost shutdown stuff. We're thinking about this listeria outbreak, decrease in demand. So we start with some sort of decrease in demand to D prime or D1 or D2. I don't know. I guess we haven't been using it. We've been trying to get away. Let's call this D1 and D2. So demand falls. What happens? Price falls to a new equilibrium. So we go down to P1, or P2 rather. Let's call that P1 where we started. How does that translate back to firm behavior? Demand shifts down, so their effective demand curve shifts down. Sometimes we draw this, sometimes we don't. So D2, MR2. What else sticking with the firm? They produce less. So they were producing the profit maximizing amount Q1. Now they're going to drop down to the profit maximizing quantity Q2. And what's true about this profit maximizing quantity Q2? What else is going on with this picture? They're incurring a loss. It's not so profitable. So I was intentionally telling you the profit maximizing quantity because it's also the loss minimizing quantity. It's the smallest amount of loss.
They're getting closer to the shutdown.
Yes, they are getting closer to the shutdown. So at this price, or at this quantity and this price for that matter, the low market price, the firm is incurring a loss. Graphically, that would be shown by the difference between price and the average total cost of producing Q2 is up here. And so watch this. This is the use of the rectangles again. That's kind of helpful sometimes. Total revenue, price times quantity. That's this rectangle. Minus total cost, which is this rectangle, the average cost per unit times the number of units. That's this big rectangle. So profits being equal to total revenue minus total cost we've got this little rectangle minus this big rectangle. We're left with this little chunk left over, which is economic profit, but in this case, it's a loss. Which is a little weird because it's a positive area of the geometry of it, but it's actually showing the loss. So you'd want to call this the economic loss rather than it being a positive profit. Okay, so how are we doing here on question number 1? Explain and use in the short run what will happen to the price of cantaloupe. Okay, in the short run, how will firms respond to the change in price? What will happen to each producer's profit? Explain using a diagram. Done. Part C. Any questions on that so far? Part C. Given the situation described in Part B, what can we expect to happen to the number of producers in the cantaloupe industry? Go down, right? There's the signal going out to the market. The average Joe out there is losing money. They have not exited the market at this point. Nobody's left at this point. That's a little bit of a kind of a funny thing maybe with kind of going from one step to the next. We're not telling all the dynamic story that might be going on. We're using our economic model to show the impact of this decrease in demand is a drop in price and the representative firm earning a loss. Why haven't any of them left yet?
They can still cover their fixed costs?
Yes, they can still cover their fixed costs, right. So they're still operating, they're still there. They haven't closed their door. So to close your door and exit the industry means you're done, right? You're moving on to something else. You're closing your business permanently. So the long run decision of exit and entry, a brand new firm coming or one firm leaving, you are varying all of your inputs. You're varying everything. You're throwing everything in the garbage. You're disposing of it all, however you want to think of it. But you are exiting the industry. That's a long run. So this is an important point, is that this is the cutoff point between the short run and the long run. So where we have it right now is at the short run. All 150 firms, we don't know how many there are. There's not enough information here. All 150 firms, all 200 firms. By the way, we could know that if this was equal to 4,200, and we knew that there was the optimal firm was producing 26 units, then 1,500 divided by 26 gives us the average production per firm, or how many firms there are in the market. So we can start to do that type of thing. You'll see that in some of your problems. But now the long run kicks in and some firms start to exit. What's the impact now? Part C now. How is that reflected in our model? Supply goes down. Supply shifts to the left. So as firms exit, that price starts to come back up and rebound. When is the exiting going to stop? When we're back to when we're back to our initial equilibrium price, which they gave it to us as what, $3? Yeah. So we had $3 per melon. Melon prices dropped. Firms started losing money. Some of them went out of business. As some of them left the industry, the supply curve started shifting to the left, bringing us up to this point, which we know we're going to get to. That's kind of a key, because that is where economic profits are once again 0. Moving from one long run equilibrium to the next. So S2 is there. And profits are once again 0. Okay, questions, comments on that? All right, so that has a whole bunch of stuff kind of jumbled up in there.
So we can say that the number of producers is going to go down?
Yes. So the number, to answer the final part of the question, yes, the number of producers are going to go down. Now, interesting with this setup again, under these assumptions of the model, the firms that remain earn the same amount that they did before, which is 0, but they're all earning the same amount of profit that they did before. There's just less of them. So some of the long run conclusions that you should know about imperfect competition. Some of the long run conclusions to perfect competition is that the firms earn a normal profit. A normal profit, which is economic profit equal to 0. We made the distinction when we started off the chapter of accounting profit and economic profit. So the firms will earn a normal profit. Firms produce a productively efficient quantity. We haven't talked about this. Little reminder from principles class. What did it mean to be productively efficient or production efficient? We know that Q1, in the long run, we're here back at Q1, and Q1 is productively efficient. Why?
Because they produce the lowest average total cost.
Good. Lowest cost. So we're at the lowest average cost. So on a per unit basis, we're really being efficient in that regard, right? So we are at the minimum point of the average total cost curve. We're minimizing cost, if you will. That's a type of efficiency. Firms are producing an allocatively efficient quantity. We haven't talked about these concepts as much in this class yet. An allocatively efficient quantity. What did it mean to be allocatively efficient? Close.
They're not producing more than they're supposed to.
True, but why? So think of production efficiency was all about costs, right? It was all about costs. If you want to, just to dust off a few cobwebs here, the production possibilities frontier, or the production possibilities curve, that was being at a point, A, B, or C. All of those were productively efficient. We could find a point where we were producing at the minimum cost. We're being efficient. But allocative efficiency was slightly different. Not all of these points are allocatively efficient. What did we need to enter into the picture to think about allocative efficiency? The demand. So we, in addition to thinking about marginal cost, we also think about marginal, not revenue, but benefit. And so in the grand scheme of things, the supply curve and the demand curve, we've learned that the supply curve is the marginal cost curve, and the demand curve reflects the benefits, as we did from the utility chapters, chapters 4 and 5. The demand curve is the marginal benefit curve. And so society's pretty darn happy at this point. The benefit of the last unit produced is equal to the cost of the last unit. And so we brought in consumer preferences. Only one point on this curve. We're going to get to this in general equilibrium, but let me, this is kind of fun, I think. Well, fun for me. But remember that utility function and indifference? As we start to think A, B, or C, those are all equally productively efficient. Well, if our preference structure is such that our indifference curves look like this, then I'm going to be the happiest at this point right there. That's where allocative efficiency happens, where we've taken into account the benefits of the good. Okay? Yeah. It's not benefit is more general. So when we're talking about a firm, the marginal benefit is the marginal revenue. So I'm glad you pointed that out. So it is marginal revenue. Marginal benefit is just more generic.
So you can apply it to commerce.
Yes, we could apply it to either consumer theory or producer theory by thinking about it as the benefit. If we got into a nonprofit company, then the benefit would be maybe another soul saved for the church or whatever, or another whale saved for the Greenpeace. So if we have some other, whatever our objective function is, we start thinking about the benefits of our behavior, and then there's the cost of our behavior. All right. Anything else on this problem? So I wanted to run the overheads to what we did last time. And some of them I'll skip over. Basically, I just have the stock photos from your textbook. All right, let's see if I can get the clicker going here. So we got this little table that is a quick flyby of where we're going with the material ultimately. There's our 4 market structures. Here is the characteristics of the market that we've looked at many times. So perfect competition, many firms, identical products, no barriers to entry, free entry and exit. And then we start tweaking them. So those are those 3 characteristics. I did the same thing in principles class. It kind of gives you the overall flyby of different market structures that the firm might be operating in. All right, we did that a lot today. Any questions on these pictures? I tend not to draw these pictures in class. It's a different look at the math. For some of you, you might get a little bit more out of it than others. But we've got a total cost function with an inflection point, the way it goes up. Marginal cost being the slope. How does this slope change if this is increasing at an increasing rate? That slope's getting steeper, 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 right? And that's where our increasing marginal cost curve comes from. So if we take those tangent points and map them out, 1, 2, 3, 4, 5, 6 units. If we take those points of tangency with that graph, that's where we get our upward sloping marginal cost curve. As we move up. So that's our marginal cost curve coming to us from this picture. So as you look through, they might show both just to kind of try to gel things together. Chelsea?
On the total revenue, is it constant because this looks like a perfectly competitive firm?
Yes. Yep. And so that's what gives us our marginal revenue being constant as well, right? So it's always equal to a constant slope. I sell another unit, I get $3. Another cantaloupe, I get $3. I get $3, I get $3, so the slope is constant at 3, using that example. Anything else? Profit, difference between, so you see this vertical distance between, that's what gives us maximizing profit. There's only one quantity that maximizes profits, and that's where the revenue generated by the last unit is equal to the cost of the last unit. It's where the slopes are equal in this graph. So in our other picture, it's where those 2 lines cross. Okay. Let's see. So that was that picture. Negative profit, 0 profit. Breakdown of the shutdown. We spent quite a bit of time in that table form. Questions on that? Kind of handy to have a quick snapshot. minimum points. There's the supply curve. So as you start to look at these, hopefully it'll start to become easier and easier for you to tell these little background stories, right? That's kind of what I want you to do, and that's why I wanted to bring this through, is to think, oh yeah, that looks this way because marginal cost curve always cuts through the minimum of these two. The supply curve is the marginal cost curve. You kind of have these background concepts as we work through. All right, that was from some. All right, so they go through a couple different graphs here of what we did earlier. And one thing to point out is to think about it can be kind of weird. It worked out pretty nicely in that example we did today because we started at the origin and then we just had the two graphs and we got 700p. That's not likely to be the case in a more general setting. So here at low prices, these are working out okay. At this price, this firm produces that much, this firm produces that much. We add those two together. This distance plus this distance equals that distance, right? So we're adding the quantities together. So then is this more elastic or less elastic compared to the individual supply curves? More elastic. So the industry supply curve is always going to be a little flatter because of that summation thing as we go. So, but that kind of talks, when we have a linear form like we had earlier, it just made it a little bit flatter. But then when we start having other firms enter the market, once we get above their choke price, then you get these discontinuous jumps. And so at this price, we got this guy plus this guy equaled this, but then this guy jumped into the market. Boom, flat spot, jumped us into the market, right? And then we go up. And so the industry supply curve looks something like this. When you start to look at data, you know, we just kind of maybe have a functional form that fits that, or sometimes it's left in this discrete jumps. So if you had a demand curve for this problem, and its functional form was such that it looked like this, then you'd only be using some of these. You'd be using all all four of the functions in this case to determine the industry supply curve. This would be the only relevant piece. So when you do the QA plus QB plus QC plus QD, kind of similar to what we did earlier today, you would ignore this jump. You won't need it. This would be the relevant piece. But if your functional form looked like this, then you'd only have the three firms in there, not firm D. So just something to be aware of at this point. I think there's a few problems, or one problem that gets into adding the industry supply. This is just some little nuances that you come up with as you look a little deeper into the problems. Okay, producer surplus. The book goes through a couple interesting examples. That's all this. Anytime you see a stair-step type thing, it's kind of doing something similar to what I just went through. Long run, all costs are variable. I think that's it. I think we'll call it a day there.